seeing a narrowing market. The market's actually trading at a pretty high valuation, too, about 22 times forward earnings. I want to ask you, how do you play this market with the narrowing trend that we're seeing? And also, it seems like tech has just kind of rose back to dominance and leadership.
Yeah, I think that we feel that it has risen back to dominance right now, but that's the biggest risk in the market right now, this overconcentration in tech. And we saw this with NVIDIA, which is already in correction territory. So we really feel that going into 2025, investors should start to take this opportunity and broaden their scope a bit.
All right, so broaden your scope out a bit. I do have to ask, so we have a Fed decision coming up tomorrow. The cut, widely expected. I think if you look at the CME Fed Watch tool, it's like 95% of traders expect to get that quarter-point cut. But there's a lot of talk if we're going to see a hawkish pause or a dovish pause, or we definitely get a pause in January. Doesn't that change the thesis on some of these cyclical sectors, the idea that the rate cut path is not going to be as straight as we previously thought, and there may be less cuts next year than previously thought?
Well, we think that we'll most likely still get three cuts of 25 basis points each, because we feel that under the Trump administration, there are actually going to be several deflationary factors in play. First of all, we think with this pro-growth agenda, the return on capital in the US is going to be far greater than the rest of the world, so the dollar gets stronger. I think with greater use of artificial intelligence, we'll start to see productivity increases. And Trump is very serious about scaling back on government expenses with the appointment of Elon Musk. All these factors, in our opinion, are deflationary, so we potentially will see 3 rate cuts next year as well.
Aadil, in all fairness, this is a little bit contrarian, the idea that we're going to see a weaker dollar, the dollar weakening, especially with the idea of tariffs and some of their protectionism. Wouldn't that lead the dollar to be stronger? And then on the back end, the idea of cutting government spending. I mean, a lot of people have gone into D.C. saying they're going to cut government spending. It's a longer-term agenda. It's a longer-term plan. What about the bond market? Don't you see them possibly reacting? Wouldn't that impact some of these cyclical trades if we saw, the quote-unquote bond vigilantes kind of, make their voices heard and we saw yields rise?
Yeah, I think that yes, those factors are in play, but I think that in the U.S. we will see greater potential, and I think that is why we should start to see deflationary factors outweigh all these other factors. And I think that for that reason, investors should try to de-risk their portfolio and improve the breadth in their overall portfolio.
All right, so I want to talk to you about that. So you're saying you want your customers, your clients, to de-risk their portfolios. At the same time, you're saying now is not the time for index investing. Generally, to hedge risk, you invest in the index. You're kind of invested in a broad index. I'm just looking at the S&P. Obviously, if you want to invest in it, that's the SPY. There's some other products, but widely used SPI. The median target for the S&P next year is 6,600 after 2 years of a bull market. That's like a 7-8% rise. The EPS estimate is 14% growth. Why wouldn't you just park your money in the index and let it ride? Because if this actually happens, this is really good. What other way is there to play the market if you're saying you're trying to avoid an overconcentration in tech, that you can get these kind of returns as opposed to just putting your money in an index fund? Just what's the other way?
Yeah, so I think that if you look at the SPY index fund, that's more than 40% invested in tech.
Right.
And we actually think that going into 2025, there are going to be 2 phases in the market. The first phase is going to be where consumers and businesses are going to scale back till we get some new clarity on what the policies are. And that'll cause a pullback in the first half of 2025. In the second half of 2025, we get the trifecta effect. Low rates, less regulations, less taxes, and the market goes up. So investors could get defensive right now and then play offensive. And when you're playing offensive, you want to go in other areas, not just tech, because we'll start to see more of what we are seeing happen with NVIDIA, in our opinion, going into next year.
But in all fairness, if you get those results, if we get what the expectations are from the S&P next year, after 2 really strong years, that's pretty good, wouldn't it? Wouldn't it be?
Yeah, it would be good, but okay. We also feel that there's more potential in areas like financials, utilities, energies, which we feel will outperform the tech sector.
All right.